The retail apocalypse has hit Minnesota. It's come to my attention quite recently that the Minnesota-based outdoor sporting goods retailer Gander Mountain is going to close a little bit less than half of its 126 stores. Earlier this year, they filed for Chapter 11 bankruptcy, and apparently they've been taken over by the celebrity investor Marcus Lemonis. And of course, this is not a new trend. Over the past 3 years, we've seen thousands of retail stores closing over the course of the entire country. And this is reason for the term the retail apocalypse, which was coined a little bit earlier in 2015. And of course, this doesn't spell very good things for the Minnesota economy. For those who are not aware, retail is a pretty large sector in Minnesota here, since we have several very large retail chains like Target, Best Buy, which had their starts here in Minnesota and actually have their corporate offices in the Minneapolis, Twin Cities metro area. We also have the Mall of America, which is currently the largest mall in the country here. And for those who are residents, probably remember back in 2015, Target corporate actually laid off 1,700 of its corporate office employees, which represented about 13% of their office staff. So quite a big hit there. And perhaps unrelated was earlier that same year, Target faced quite a big loss in Canada as they were forced to bankrupt their Canadian subsidiary, which was Target Canada, and forced to close all 133 of their stores in the country. So I wanted to talk a little bit about why this is happening. I think a lot of people are under the impression that the online retailers like Amazon and so forth have been taking sales away from these brick and mortar guys, but of course that's just simply not quite true. So going back a little bit over history here, we had the 2008 financial debacle, where we had a correction in the stock market, the real estate market melted down, bankruptcy of AIG, so on and so forth. And we had an economic contraction between the years of 2008 and 2009. And of course, right around 2010 is when the Federal Reserve started its stimulus programs. And of course, that's when we heard all the financial channels start to say really, really amorous things towards the American economy, saying, oh, the recession is over, good times are here again. But of course, what the Federal Reserve was trying to do is stimulate the economy by getting credit going again with their suppression of interest rates to near zero. And then, of course, they started their quantitative easing programs, of course, as well. And if you hear quantitative easing, just go ahead and think money printing, because that's essentially what it is. What they're doing is they're taking bad debts off of the balance sheets of some of the larger banks in order to attempt to get these banks to start lending and start getting credit out there again with cleaner balance sheets. And the reason why they needed to get credit going again in order to stimulate the economy is, of course, because our economy is now a consumer-based service sector economy. And what that means is that we don't really produce any tangible things here in America anymore. Most of our economic productivity is through the production of services, and in retail in particular, it's the service of taking foreign goods that we have to import now and then selling it straight to the American consumer. And so let's take a look at the Federal Reserve's policy, and in their own numbers, let's see how well they did. And I want to give a shout out to Michael Snyder, who did a really good article that I'm actually going to link to below, talking a little bit about the money velocity. And so as you can see here from the graph, the money velocity is at historic lows, actually the lowest point that they've ever been since they started compiling the data back in the 1960s. So what is money velocity? It's basically a measurement of how quickly money moves through an economy. So if an economy is doing really well, obviously money is changing hands, everything's good. When an economy is in decline, when it's contracting, then the money velocity will be low and less money will be changing hands. So they've definitely failed to get this money circulating in the economy, and they've also failed to hit their inflation goals over the years too, for those who have been following the Federal Reserve monetary policy. But of course, one thing that they did manage to do with all this money is blow up a big bubble in the stock market. So this is the Dow Jones Industrial Average, and you can see right here, that's the 2008 correction, the stock market crash, and right now we are at 21,000 on the Dow. Give a little shout out to Fabian Calvo for calling it here. He said a couple years ago that when everybody else was saying that the Dow Jones was going to top out at 18,000, he said, nope, we're going to 20,000 and beyond. So very good prediction there. So they managed to, instead of get all of that money circulating in the economy, it's now stuck in the equity markets. So I wanted to talk a little bit about why exactly these policies failed. And it's for the very simple fact that there is no law in economics that states that just because you give someone money means that they're going to go out and they're going to spend it. There's actually two other things that people can do with their money. They can stick it in the bank, or they can use it to pay down debt. Paying down debt is something that the Federal Reserve definitely doesn't want the American people to do, because that's very deflationary. They would much rather that people go out and they spend it in the economy, of course, to get it all stimulated. But of course, we also know that they're not saving it for sure. We can just look at the savings rate, and we can see that we're at very low levels in the savings rate. And you can probably tell anecdotally too, a lot of Americans don't have more than a couple weeks worth of savings anyway. So this is all why I expect the retail apocalypse trend to continue. We actually just got the June sales report for 2017, the retail sales, which failed to hit its mark yet again. They did less than sales that they wanted to do, 0.2% down as opposed to the 0.1% that they were expecting. So we can expect to see a lot of failures to hit the projected targets going forward here. So, and then one last thing. This is all proof, of course, that the stock market is definitely not an indicator of how well the underlying economy is doing, because we've seen this bubble, and of course, the things that the Federal Reserve wanted to get done in the economy definitely did not happen. So if you find yourself in an argument with somebody about the strength of the American economy, and they say that the economy is, oh no, it's doing well because just look at the stock market, well then, you have my permission to laugh at them, and then go ahead and send them this video. So I hope you got something out of this. I expand upon this in great detail in the Steemit article that I wrote that I will link to below. So what do you think? Am I way off base? Am I an asshole? Why don't you let me know in the comments section below.